my gosh, the market's crashing. What do you do? Well, we're going to talk about that and how to keep your cool when the market seems to be in chaos coming up next. Hi everybody, my name is Dee Burks and this is Retirement Rescue, where we talk about how to make money, save money, and build a retirement from nothing. Well, on days like today, when you get up and the market is taking a huge dive, what do? It's easy, and I mean easy, to suddenly panic and think, oh my gosh, oh my gosh, oh my gosh. But if you're going to be a good long-term trader, the market going down is part of it. And the thing is, you know this. You know the market goes up, the market goes down, and that's real easy to say and be totally comfortable with when the market's going up. How you react to a market downswing is going to determine if you're going to make it as a trader or not. Because it's in those down times that you either give up and lose all your money, or you understand that every downswing presents opportunity. Now, which is it going to be? Now, I'm going to lead you through 5 different areas that you need to think about and really decide for yourself how you're going to react when the market takes the next downswing. The most important one of these is think about your losses. And don't just think about, oh yeah, the market could go down 20%. What does that mean? How much do you have in your account? If you were to wake up tomorrow and the market was down 20% or 30%, how much money is that in real dollars? Are you okay with that amount of money being set on fire right in front of you? That's what you need to ask yourself. We're all good at that theoretical risk. Oh yeah, we're good with risk. Oh yeah, it's not a big deal, no problem. Until it happens. And you'll see a lot of new traders or inexperienced traders, even some really experienced traders, panic. They will panic and they will sell at the bottom. They will get out. They are so fearful that they will get out right at the bottom. And if they do that enough times, they'll run out of money. And so will you. So you really have to think through those losses and think through the reality of a down market before you allow that fear and that panic to set in. And the best way to do that is know your stocks. Know your stocks. I tend to be heavy in biotech. So here recently, when Apple and Tesla took a big dive, biotech stayed pretty even. I mean, it took a little dip, but that was it. And so there were people who were like, oh, the market's down 800 points. What are you going to do? And I'm like, not big. Okay? I know how my stocks react. So I don't panic. You've got to remember those indexes are made up of a group of stocks that are representative of all the sectors. It doesn't mean your particular stocks will perform in the same way. Now, having said that, there are days the market's up and my stocks are down. So you have to know your particular stocks. You have to know how they react to good news, to bad news, to overall market conditions. And it's really easy to go back on any stock into the historical charts and see exactly how they reacted. If the Dow Jones or the NASDAQ index took a big dive, how did that particular stock react? Did it take a big dive too? Was it a sector that affected that stock? Or was it not, like in my case with biotechs? And this brings up number 2. When you are first making the decision on what your risk tolerance will be and how much of a swing that you're going to endure before you have a stop loss, when you're making those decisions, it's hard to do in a vacuum. It's hard to do when you're not looking at a stock that's just dropped 20%. Because you really think, and everyone does this, your risk tolerance is higher than it is. We all think that. We all think, oh, I could do 20%, 30%. Oh, not a big deal, 30%. I'm sophisticated, I could do that. Well, yeah, but then it goes down 5% and you panic. So clearly, what you think your risk tolerance is and what it truly is are very different things. The only way you really learn that is to experience it, unfortunately. And this brings up one of those things that a lot of people do. They say, well, I'm going to trade with paper money for a while to kind of get my feet wet. And that's great. It's great that you play with that sort of thing before you use actual money. But most people trade very differently when it's real money. That's why I tell people, start with a small account or a small percentage of your money that you're going to actively trade with and you're going to personally manage. Leave the rest of it alone. Start with a small amount and figure these things out with that small amount. Number 3. This sounds a little silly, but one of the best things you can do when you see the market down is to give yourself a little pep talk. Remind yourself, the market always comes back. The market's due for a correction. It's not a big deal. It's reacting to this. Go through in your mind what is going on. And it will make you much more comfortable with what is going on. But hedge fund traders do this all the time. Because believe me, they're trading much like those of us who are swing traders. They're doing short-term investments, trying to make much more gain than a fund, a regular retirement fund, that's just looking for a long-term gain. They're trying to beat the market. And so they're going to be trading just like you or I would. And they have a lot more money on the line. But let me tell you what, they have to stop and give themselves pep talks. It's easy to get down on yourself when you make several bad trades in a row or the market goes down and all your stocks are down. It's easy to want to go out and have the 8 martini lunch or whatever because you know it's just crap. But you have to give yourself that pep talk. Number 4 is stick to your plan. For some reason, it is human nature to hold on to losers because you think it's going to come back. When your plan says, okay, when you hit 15% loss, you're out. And it'll get to 15% and you think, oh, but I don't want to get out at the bottom. Just a little bit more. And then it's 20% and then it's 25%. And you start to really panic because you have stepped way outside your comfort zone. And you should panic, by the way. You stepped outside your plan. That's a big no-no. Because conversely, when the stock is going up, you have no problem just harvesting your profits at 10 or 15% instead of letting it run. So what happens is over time, you make less and less profit and you have more and more losers because you're stepping outside that plan. You've got to convince yourself you can always get back in. If you want to get back in, it's not that big a deal, but you have got to mitigate that risk. And you have got to stick to your plan in order to do it because the plan was made when you had your wits about you, when the market wasn't taking a big dive, when you were really looking at the numbers and looking at the data. So you don't want to now make a decision that's emotional because the market is suddenly taking a dive that's outside that plan. So stick to your plan. And number 5, do not allow yourself to make fear-based, emotional decisions. I just talked about this, but the thing is, when you make a fear-based decision, it always leads to regret and you will remember it forever. It leads to regret because you knew you did it wrong. Then you made an emotional decision and made it worse. And now you have to live with the consequences, which is a bigger loss than you ever should have taken. So never allow yourself to make fear-based decisions. Think through everything. Make your decisions up front about what you're going to do if. Stick to it. Stick to it. So these are just a few hints that when the market goes down, there are ways you can get back into the mindset of a good, calm, thoughtful trader. Now, if you've liked this video, please click subscribe, and I'll see you next time.